There are some accusations, Mohamed, that this is selective analysis on behalf of the Fed. R-star mattered as they began to normalise, and then as they get close to R-star, it no longer matters. Can you walk me through how you think about that dynamic at the moment?
I think it's a change in regime. I think that's the key issue that has happened within the Fed. And it raises not just one, but three questions, John. First is if, like Mike said, R-star and U-star are no longer the North Star, what is? And markets would be interested to know what is the North Star. The second issue it raises is, will they nudge up market expectations to their path for interest rate hikes? And the third issue that is raised is, what about financial stability? This Fed has put relatively greater emphasis on that issue than the previous Fed. So I think this is a really interesting time to watch how the Fed is going to react. And markets are going to expect answers at some point on all three.
So, Mohamed, let's pick up on that third and final point on financial stability. I've heard Chairman Powell reference that many, many times and pointing out that over the last couple of decades, financial crises have been the cause of recession, not upside surprises to inflation. But he doesn't go into much detail. When you lift the lid on financial conditions in the United States at the moment, are there pockets that you think they should be more concerned? What's the detail behind it?
Oh, they should be concerned about excessive promises that have been given about liquidity, especially in illiquid asset classes. They should be concerned about where high-yield bonds are trading and what that tells you about risk-taking. And the question is it enough to rely just on macro and micro potential policies? Most people tell you that that's necessary but not sufficient, and that monetary policy has a role to play. This Fed seems to be a little bit more comfortable with that notion, but we are yet to see how far they're willing to go with it.
So, Mohamed, you and I could have a real discussion about what should guide the Fed. I guess what's more useful just to allocate capital is what will guide the Fed. What do you think is guiding the Federal Reserve right here, right now?
A very strong U.S. economy. And because of that, both elements of the dual mandates are either met or will be met soon. And if it weren't for the rest of the world, they would see a clear path to tightening at the same rate as what's implied in the dots, if not more. I think it's the rest of the world that makes them a little bit more cautious, but of course they're not going to express that very loudly.
So, Mohamed, from what you've said over the last couple of minutes, it makes me think that tension out to 2019, 2020 between market expectations lower than Federal Reserve expectations for rates, do you think it reconciles with the market coming up towards the Fed?
Yes, absolutely.
How are they going to go about engineering that change, and when do they need to make that communication shift to actually get the markets to come with them?
Well, they're doing it very gradually. You've seen the market edge up closer to the Fed. And in the last 2 years, that has been the story. Earlier, it was always the Fed coming down to the markets, but we've seen a change in regime. But they do it very carefully because they don't want to derail economic growth, and they don't want to disrupt markets too much. So it's very gradual, but I think that ultimately the convergence will happen from markets going up to what the Fed has already signaled.
So, Mohamed, that's the framework for thinking about the Fed and what it could mean for rates. Let's apply that to the Treasury curve. Push that view through the Treasury curve. How should we be priced from 2s through to 30s? How do you see that shape of the curve evolving with all of that in mind?
Higher and a steeper curve.
Interesting.
And not just because of the Fed, but because two non-commercial buyers who have had a big influence on the shape of the curve are stepping back slowly. LDI, liability-driven investment, and the spillover from the ECB and the Bank of Japan. So I'm looking for higher rates and a steeper curve, but nothing massively dramatic and disruptive.
So, Mohamed, some people might challenge this and say, well, Mohamed, if you're going to be right, if the Federal Reserve is going to go quicker than the market, I would expect some kind of bear flanner where the front end sounds off more aggressively than the long end because we need to price in more rate hikes. But you're saying the whole curve is going to shift up. That seems pretty sort of non-consensus right now. Would you agree?
Yeah, and I think also the implications for the dollar are non-consensus. I expect the dollar to get stronger from here. A lot of people are saying the dollar is going to get weaker from here. That's why I think it's too early to fade the divergence trade.